Good morning, Ian. I'm very happy that you're here with us. Ian McLelland is our MD who looks after our oil and gas sector, and we're here today to talk about what has been going on with the oil price. So just kicking off, Ian, could you please explain briefly why oil prices have fallen so dramatically since the start of the COVID-19 crisis?
Wow. Okay. I don't think we've really got enough time to get into too much detail here. It's such a lengthy process. But really, we genuinely are in these unprecedented times. And by the reason I say that is that oil markets move very abruptly with actually relatively small differences in supply and demand. There's roughly about 100 million barrels of oil generally consumed every day on the planet, and 1 or 2 million barrels a day of movement either in supply or demand can have very abrupt impacts on oil price. Actually, coming into the COVID crisis, we were already in a degree of immense turbulence because OPEC plus, the enlarged OPEC group that also includes Russia, had broken down in late February, early March, which meant that actually there was already the potential for quite significant oversupply of oil coming into the market, and oil prices actually really came down significantly at that point. The real issue though here is that actually nobody until very recently has predicted exactly how big the impact of COVID would be on demand. And when I come back to talking about 1 or 2 million barrels a day moves the market immensely, put this into perspective. The EIA, the US energy authorities, they were predicting 3 weeks ago that the demand in April was going to have fallen by 15 million barrels a day, right? Now, there's commentators out there saying April is going to be down by 27 million barrels a day. This is completely unprecedented. So, we've got to say that we've got an oversupply situation is just not giving it credit. Then you've got the big issue of what do you do with oversupply, and the big problem here is there is only a limited amount of physical storage on the planet. There is something in the order of 2.3, 2.5 billion barrels of onshore oil storage. And most of that was actually full coming into this crisis. It's unclear how much of that storage is usable, but there's something in the order of 500 million barrels of available storage. So you start to think about, well, okay, we're now 25, 27 million barrels a day down on demand, and you've only got 500 million barrels of storage available. Very, very quickly, that storage, in a matter of 20 days or something, that storage is going to be full. And so the world has suddenly woken up to the fact that there will be no storage available. There will be massive production cuts as a result of this. And that is why, the oil price went utterly crazy, and as was widely reported a few weeks ago, as it even went into negative territory. People were paying traders to actually take barrels off them.
That's really helpful data and context, Ian. So what do you think this means for the oil price now for the next few months, and can we get much of a recovery, do you think?
Okay, crystal ball. There are far greater minds that look at this than me. The reality is that short term, we are going to have a very, very turbulent couple of months ahead. Some people are predicting that both onshore and even offshore storage, and offshore storage being tankers, the day job is actually to move crude about. That crude is not getting moved; it's just being moored in at various places on the planet. That storage is going to be full at some point in the next 4 to 6 weeks. And there has to be, frankly, now, given the state. And I apologise. I should have mentioned earlier. OPEC did try to respond to this crisis, albeit belatedly, with some very, very draconian cuts in terms of production cuts, as OPEC can do. But it's not enough. I think they've managed to collectively, with the entire group, agree to up to 10 million barrels a day of production cuts, which is unheard of. But actually, and there's tweaking around the edges. It's probably not as much as that anyway. But the reality is that is nowhere near enough. So we're going to get to this point very, very quickly where there is going to be mass forced shut-in of production. Not on economic grounds, but simply because you simply can't move move it forward. So for the next 2 or 3 months, chaos, right? For the rest of the year and into 2021, then you're much more into looking at, well, what actually is the knock-on impact of COVID-19 on the world economy and on the recovery and demand of oil. And actually, the reality is, like everything else, is going to take a long time. So there's lots and lots of screens out there, but frankly, people are of the view that we've got 2 years of relatively low demand ahead of us, because when you think of it, and coming into almost 50% of oil that is consumed in the world actually goes into road vehicles and jet fuel and aviation. That's 50% of the oil production, and both of those markets are going to take a long time to recover because of all the shutdown, all the lockdown activities. Yes, even as they get relaxed, it's going to take a long time for that to start to flow through. So it's going to be highly uncertain, but also it's going to be depressed for quite some time to come.
There's been a lot of momentum behind renewables, certainly up until the pandemic hit. So how do you think the oil shock is going to affect the renewables sector, and is it likely to accelerate or delay the anticipated energy transition?
Oh, that's quite a tricky one to call, because there's a balance here. On one hand, it's bad news for the renewable sector, because if oil price stays low, it means that the economics for running an ICE car, an internal combustion engine car, are more favourable than switching to an electric vehicle. Okay, and what's exactly what the point, the trade-off is not entirely clear, but it's somewhere probably between $30 and $40 oil. At $50 oil, EVs were probably long-term at average mileage made more sense. Another way of looking at it, though, is we came into 2020 and we all predicted, I certainly predicted, that 2020 was going to be the year of climate change. That climate change was going to drive the capital markets and the investment decisions more than anything else. Everyone was talking about ESG. Larry Fink, with his letter to CEOs back in January, it was all about the climate change is an economic risk, and therefore, quite rightly, everyone is thinking and trying to strive to address the climate challenges as quickly as possible. And we've all the major, most of the major oil companies are making significant inroads into that. Shell very recently doubled up on its commitments. BP has got a completely new mindset here regarding this. And actually, ironically, if you then think about, well, if oil is going to be low, oil price is going to be low for quite some time to come. Actually, that therefore means that the returns that the oil companies make on oil development is actually no better than we get putting it into renewables, which are more actually, ironically, although it's new technology, is the returns are far more stable, because it's a utility type approach. So you can see this balance that exists between, on the demand side, there is probably it may well delay the take up in renewables, but actually, from the supply side, if anything, it might encourage the acceleration of the renewable agenda.
Fantastic. So, how does this relate to stock picks? What would you be doing in the sector right now with all these severe challenges? Have you got any investment ideas for us to
Investment
finish up?
ideas. Okay. Well, look, you got to get into the weeds, obviously. The the reality is that majors and the juniors, they're all delaying substantial new projects, right? That is the reality. There have been billions of dollars of capex pulled from people's budgets in the last couple of months as this has started to flow through. So a lot of the major developments that were going to that previously were built into supply demand models, those are not going to happen for the foreseeable future. At the same time, not every company is affected in the same way. So, take for example, we've got a number of Edison clients where the vast majority of their revenue stream is based on fixed term contracts. Most of those are gas contracts, and and many of them are long term, and so they're highly robust to the macro impact. Then you've got others where they recognise they have recognised the exposure to short-term volatility over a long period of time, and so they've built very aggressive, very substantial hedge books. And so, again, we've got some clients where they have the vast majority of production heavily hedged over the next 2 years, which will get us through this period of uncertainty. So, I would definitely be encouraging people to look at companies, both their hedge position and what is the contract situation that they've got. Further afield than that, oil storage is very, very interesting place to be. Actually, ironically, a lot of storage companies themselves, the way they're set up is on long-term contracts as well. So they don't necessarily see the upside to all of this turbulence in the short term. But clearly, as contracts roll over, there should be a lot of focus on that. Tanker companies are making a killing at the moment because there is this desperate need for for emergency storage. How long that's going to be required, don't really know. But you've really got to get into the weeds to see all of this.
That's fantastic. Very interesting talking to you, Ian. Thanks for your time. We'll catch up again, no doubt, in the not too distant future. Thank you.
No problem. Thanks.